how to set safe stop loss, how to identify the exact level for the safe stop placement. I finally prepared for you a big lesson on stop placement. It is the first video about risk management in my channel. You asked me a lot about that, and finally it is here, and enjoy that. Please don't forget to like this video, subscribe to my YouTube channel, and leave a lovely comment. Let's start. Alright traders, the safe stop placement can be nicely explained with the price action patterns. If you treat technical analysis, if you're interested in price action, most likely the majority of the trading opportunities that you take are based on price action patterns. And here is the list of the most common patterns that I trade, and each and every day when I am looking for trading opportunities for the confirmations, I'm trying to rely on these price action patterns. So on them I will try to explain to you how do we select proper stop placement. I will try to give you the logic here, we will discuss these patterns, and I will give you the objective rule for stop placement with these patterns. Hey traders, please give me a follow in my social networks. I have a Telegram channel where I post daily forecast and signals, and there I have 11 forecast win streak on your end. There I post very accurate forecast, around 70% win rate there, so definitely check that. Also I have Instagram where I post exclusive educational materials and exclusive ideas in stories. All the links will be in the description below. Please check that, and let's continue. So let's start here with the wedge pattern and the triangle pattern, and for the sake of the example here I apply bearish patterns. Yes, the bearish reversal patterns, and remember that most of the time when we see these patterns it is a very strong bearish clue, and once the price breaks the support of the wedge, most likely the price will drop then, and if we see the breakout of the horizontal support of the descending triangle, most of the time bearish continuation follows. So the question is right here, once we see the breakout, yes, where is our safe stop? And many traders apply different logic when they justify their stop placement. Some just say that stop must be based on the average true range of the financial instruments. Some other traders rely on the indicators. But what I'm trying to apply here, I am trying to apply just the logic, and in my view, safe stop is the level where my predictions become wrong, where I become wrong in my predictions. Yes, so let's imagine this example with the wedge pattern. We see the breakout of the support of the wedge, where we become wrong in our predictions. Is it the point where the market retests the broken support of the wedge? I guess not, and moreover it can be a very nice entry for us. Is it the point where the market retests this low high? In my view, we are wrong in our predictions only when the market violates our current structure high to the upside. So over here is our current structure high, it is the higher high, higher close. So in my view, I become wrong in my predictions trading the wedge when the market sets a new higher close in the bullish trend. Yes, remember, wedge pattern appear in a bullish trend, and it signifies the exhaustion of the market. So we say that this high right here is the last high, yes, and from here the bearish trend will initiate. But if the price goes above that, yes, if the price sets again the new higher close, then we are wrong in our predictions. So I hope this logic is clear. And to find the point where we become wrong in our predictions, I can suggest you to apply FIBs. Yes, the FIB extension. And our FIB extension, for the FIB extension, remember, it is very important for you to identify a correct leg of a move. And here we will strictly apply the leg from the structure high to the last structure low. Yes, so this leg will be important for us, because based on this leg we will execute our FIB measurements. So what I do right here, I take the FIB extension tool, and from its low to its high I draw FIB extension. And over here you can see that I have 1 to 72 fib extension level. Why this level, you may say? What I like about this level, it gives us a very safe space between the high and this level, so quite often when we see the retest of the market high, quite often we see long wicks. Yes, the market tries to go higher, but then we see the rejection, long wick, and then the market goes down. So to avoid stop hunting, your stop must be strictly above the structure, and you should give the market some space, yes, for stop hunting. Remember, market maker is the best. Market maker is always trying to stop you out. Yes, he tries to blow your account, and for that reason many people go broke, because they're so greedy. They want to make all the money in the world. For that reason they set their stops very close to their entries. But here we are trying to be smart, yes, we are trying to be safe. And with this 1272 extension, this is the safest spot for us to place our stop. Now let's discuss the example with the triangle. Alright traders, to explain to you how to place a stop loss with trading wedges, I want to discuss with you Euro Swiss pair. Over here I hope you see that the pair right now is trading within this falling wedge pattern. Yes, you can see how weird it is, and you can see that in the long run here the market is trading in a very sharp bullish trend. But locally, once the price reached this high right here, we started to trade in a local bearish trend. Yes, and locally within this narrow area within the wedge, the market is bearish. And the market will return back to the bullish trend once we violate the resistance of the wedge to the upside. Yes, it is the condition that we are looking for. So once it breaks the wedge to the upside, we will look for the retest as our entry. But where will be our safe stop right here? Where will be safe for us to set our stop? Will it be just right here within the boundaries of the wedge? No, remember, yes, that we are wrong in our predictions if only the market drops below the current low. Yes, because it will lead to the bearish trend continuation. So our stop here must be below the low of the wedge. To identify that correctly, remember, we first of all look for the structure low, yes, and then we are looking for the recent high right here. So here is the leg that we need for our stop placement, yes. So we will take this leg, and based on that we will take fib extension tool, yes, and from the high right here to low we will draw the fibs. Over here we get this 1272 extension, and right now let's measure potential risk to reward for the trade. So our stop will be right here, and for the target here, because it is the trend following trade, we will aim at some higher structure levels. So for the sake of the example, let's rely here on round numbers, and let's 1.112 will be our next goal. So again, you can see that our stop is quite wide. Yes, for safety we pay a lot of pips, but if you drive BM, you know that the insurance is a very expensive thing. Yes, and to make our position safe, yes, to increase our win rate, we need such a wide stop loss. Yes, because only with such a stop we can take the market volatility, we can avoid market maker, yes, we can avoid stop hunters. So this is how we select safe stop trading wedges. What do we know about the descending triangle formation? Descending triangle formation is also a reversal pattern, yes, and we trade it when the market is trading in a bullish trend. And for us, again, descending triangle signifies the weakness of buyers and the change in the market sentiment from bullish to bearish, yes. And for the trigger that we are looking for is the breakout of the horizontal support of the triangle to the downside. Yes, most of the time it is a very reliable signal. So where is our stop placement right here? Where we become wrong in our predictions. We become wrong in our predictions if only the market sets new structure high right here. Yes, if only we see the new structure high, new higher high, higher close, only then we see, according to our classic price action rules, the classic bullish trend continuation. But until the market is trading below current structure high, until it is below, it still can reverse. Yes, quite often with my students, when we hold some trading position, when we are trying to catch the market reversal, quite often we have this, the position drawdown when the market is trading around our stop, and my students worry about if it the moment to close the position. But I say we hold because we still can be right in our predictions. Yes, and stop loss is our only judge in this game. Never let your emotions close your trading position. So right here, to properly set the stop loss, again we will apply the step extension. Yes, and remember, as I told you, we choose for the fib drawings, we choose the leg from the structure high to the structure low. Yes, to the last structure low. So here is our leg. Yes, let me underline that for you. This leg here is very important for us. And we take the fib extension tool, and from its low to its high, we will set our stop. Yes, so our stop here will be based again on the 1272 extension. What is good about 1272 extension is that it gives us the scalable stop. No matter how wide, how big your pattern is, how small it is, 1272 extension adjusts your stop to the length of the leg. Yes, so there is no need to always make the subjective calculations. Here is your objective stop, and moreover you can back test the market with that. Yes, with each and every time frame, each and every instrument. The FEPs give you the measurements based on the lag of a move. Yes. Now let's discuss the last patterns that we have. So double top and head and shoulders pattern. And if you follow me on Telegram, you know how frequently I apply these patterns in trading. And head and shoulders is my favorite pattern. Yes, I guess it is one of the most accurate price action patterns, and definitely I recommend you to try to trade that. So what we know about these patterns again is that these are the reversal patterns. Yes, and we look for them when the market is trading in a bullish trend. Yes, in the bullish trend, at some moment with a double top, the market can set a new structure high. Instead of that, it sets the equal high or even the low high, and forms here a local neckline. And once the neckline is broken to the downside, then we expect the bearish trend continuation. And again, ask yourself, where is your safe stop? Where you become wrong in your predictions? You become wrong in your predictions if only from after the breakout the price sets new structure high. Yes, because according to our classic price action rules, it signifies bullish trend continuation. So you find your last structure high, you find your last structure low, and based on that, you draw the fib extension. Yes, you take your neckline, you take your high over here, yes, and you draw the fib extension. And again, you see, it gives us the scalable stop. It gives us a nice space between our current high and this 1272 extension. So I consider the stop right here to be very safe. So if in theoretical example we discussed double top, here in the example I want to give you double bottom. So over here on New Zealand CAD, if we draw the horizontal line, you can see that the market right now is approaching a quite strong key level. Yes, you can see that in the past we saw quite strong reactions from that structure, and right now the market is testing that level. If we open the hourly chart on that, yes, and if we analyze the recent price action right here, you can see that right now the market formed here a double bottom formation. Do you see that? Let's follow the price action together. Here is our first test of the low, then we see the retracement, yes, then the retest of the low, and then the market returns back to the neckline. Yes, so over here we have our neckline. What happens next? The market violates the neckline to the upside, yes, and for us it is a very strong bullish signal, and now we expect a strong bullish continuation. So Our entry, my preferable entry, is on a retest. Yes, I am kind of the retest guy, very conservative trader. And you can see that the market right now is trading below the neckline already. So am I wrong in my predictions? Am I wrong, and is it the time to close the position? No. Remember, where is our safe stop? Our safe stop is below the low right here. Yes, because only once the price here sets the new lower close, it signifies bearish continuation. Yes, and here we will treat this breakout as the false breakout. So for that, over here to identify our stop, we will take the last high, yes, and our lower low, yes, and based on that we will draw the fib extension. Here we got our stop loss. Yes, it is 1272 extension. And now let's execute the risk to reward analysis. Our entry is the neckline. Yes, our entry is the neckline of the double bottom. Our stop here is below the low, yes, and our target here will be the closest strong structural resistance. Yes, and as you can see over here, we have quite strong structural resistance. So here's our trading position. You can see that we don't have the 5-to-1 risk to reward, but we have very safe trading position. Yes, and only if the market drops below the low, only then we become wrong in our predictions, and only then we close our position. For now it still looks healthy. For now we already had this breakout, the mood is very good, yes, and we are happy that we have this active trading position. For now just patience, and let's wait until the market reaches our stop or reaches our goal. We never know, but here how we select the safe stop placement. And last but not least is the head and shoulders pattern. You know, we even call that the variation of this classic double top pattern, and here the price sets the high first, then the new higher high, and then the lower high, and each and every time the price respects the same low that we call the neckline. And again we are looking for a breakout to confirm the trend change, trend reversal, and once it breaks for us, it is a strong signal to short the market. And you know, here's a very tricky thing about the stop placement, because sometimes definitely we set our stop above the right shoulder, but it always depends on the length of the right shoulder, and quite often, most of the time, right shoulder is almost equal, you know, the high. They are very similar, and right shoulder is just a bit smaller, like right here. So in such kind of situation, again, you know, to make it safe, to make your position safe, think where are you wrong where you become wrong in your predictions. You become wrong in your predictions once the price sets new higher close. So your stop placement again will be above the head. Yes. So you take your bearish move right here, this bearish leg, and from its low to its high you take 1272 extension, and here you get your safe stop placement. I'd really want you to try this stop placement. I know how greedy you are, you know, I know how tight stops you have, you know. Quite often my followers send me their trading positions with very small stops, you know, they want 10-to-1 risk to reward, 20-to-1. Unfortunately, we should embrace the reality. To make it safe, we must have this wide stops. This is the only way to beat the market maker. Alright traders, thank you so much for watching. It was the first video about risk management in my channel. I hope that right now you know how to properly set a safe stop loss, and now try these techniques and see how efficient they are. Don't forget to give me the follow in my social networks, all the links are in the description below. Don't forget to subscribe to my YouTube channel, like this video, and leave a lovely comment. Thank you so much for watching.